Did you see ASTS on August 11th and 12th? The stock dropped 2% on what looked like bad news, then rocketed up 8% at market close the very next day. If that kind of whipsaw price action left you feeling confused, you are definitely not alone. The truth is, most of the market completely misread the story. Alright, if you don't have time to spare to listen to a random guy on YouTube, here is the essence of this matter. The market is supposed to be forward-looking. The initial drop was a reaction to old news, to past expenses. The surge that followed was the market finally waking up and pricing in the ASTS very real and increasingly de-risked plan for the future. Understanding that distinction is absolutely critical. Hey everyone, DataCat here. For those of you who are new to the channel, I'm pretty new to this too. My channel is only about a month old. I used to be an analyst, a corporate slave really, herding spreadsheets inside a Fortune 50 company. I traded that life for a keyboard and a camera to try and make sense of the markets for you. And on that note, my apologies for being quiet the last couple of days. I'm trying to make a habit of posting daily updates, but I only want to talk when I feel I have something genuinely valuable to share, not just to feed the algorithm. If that's the kind of no-nonsense analysis you're looking for, consider subscribing. It helps a small new channel like this one a great deal. Okay, so let's break down what actually happened with AST SpaceMobile. On August 11th, the stock took a dip. The reason was the company's second quarter earnings report. They announced a loss of 41 cents per share, which was wider than what analysts were expecting. On top of that, their spending was way up. Total operating expenses climbed by $10.3 million, and their capital spending hit $323 million, which was significantly higher than the $270 million they had guided for. Now, for a company that isn't bringing in substantial revenue yet, seeing a bigger loss and a higher cash burn can be a red flag, especially under the market context we've discussed in my previous videos. The market saw these headlines and, like a cat seeing a cucumber for the first time, freaked out. It's a classic headline-driven reaction, but here is what the algorithms and the headline readers missed. That spending wasn't waste, it was strategy. The company was being smart. They were buying satellite materials early to get ahead of potential tariffs. They also pulled forward a $25 million launch payment to solidify a key partnership. That isn't bearish spending, but a proactive strategic planning. And the most important piece of the puzzle they ignored, the cash position. The company is sitting on over $1.5 billion. The chief financial officer came right out and stated it on the call, saying, "We do believe that we are fully funded now to reach the 45 to 60 satellite level." Let that sink in. They have the money they need to build out their initial constellation and begin generating continuous service revenue. This single statement removes a massive amount of funding risk from the equation. So the very next day, August 12th, the stock closes up over 8%. What changed in 24 hours? The market had time to actually digest the report and listen to the conference call. Investors shifted their focus from the backward-looking profit and loss statement to the forward-looking operational milestones. The biggest catalyst was the launch plan. Management laid out a concrete schedule for at least 5 orbital launches by the end of the first quarter of 2026. They're talking about a launch happening every 1 to 2 months. This transforms the company's goal from an abstract business plan into a scheduled engineering project. The market rewards that kind of certainty. Then you have the government contracts. They secured 2 more, bringing their total to 8. The United States government is one of the most demanding customers in the world. Getting their stamp of approval is a powerful validation of the technology. Management also highlighted that these smaller initial contracts are the on-ramp to becoming a program of record, which they estimate are typically worth north of $100 million. That provides a very clear path to substantial non-dilutive revenue. And this next point is a big one for the long-term story. They acquired global S-band spectrum rights. Owning your own spectrum is the ultimate competitive moat. It's like being the only cat in the neighborhood with a key to the tuna cannery. It gives you control, reduces your reliance on partners, and it creates what the CEO called a durable competitive advantage. If this dynamic feels familiar, it should. Think about early-stage Tesla. For years, all the headlines screamed about how much cash they were burning and how they kept missing production targets. The stock was volatile, but eventually the market learned to ignore the quarterly loss and focus on the one metric that truly mattered: how many cars were they delivering? Or simply Tesla's manufacturing capabilities as a moat. And now, ASTS's satellite production and launch cadence is the leading indicator of future success. Okay, so that's the fundamental story. Now let's pull up the chart and see what the price action is telling us. And just a reminder, this is for educational purposes, not financial advice. You have to do your own research. Let's zoom right in on August 12th, that big 8% surge day. The first thing we see is what traders call a gap up. This means the stock opened for trading significantly higher than where it had closed the previous day, leaving a space or a gap on the chart. This is usually caused by major news released outside market hours. This gap up created a very specific and telling daily candle shape known as a shooting star. Imagine the price launching upwards at the start of the day like a rocket, hitting a high of $55.50. But then it ran out of steam and fell back down for the rest of the session, closing much lower at $49.76. That long thin line you see at the top of the candle, the wick, represents that entire intraday journey. It's a visual story of a battle. The buyers came in strong in the morning, but the sellers came in with even more force at those higher prices and pushed the stock back down. It's like a cat that triumphantly pounces on a toy mouse only to have it snatched away at the last second. The fact that this all happened on very high volume, about 2 times the recent average, tells us that this was a significant, hard-fought battle between buyers and sellers. Now, let's zoom out to see where this one day fits into the bigger picture. To understand the overall trend, we can use our good old friends moving averages to show us the general market direction. For the long-term trend, the stock is still in a healthy uptrend. We have what's called a golden cross in effect, where the 50-day moving average is trading above the 200-day moving average. This is a classic long-term bullish signal. However, the short-term picture is more conflicted. The price is currently sitting just below its 20-day moving average. Right now, the price is bumping its head against this line, which is acting as a temporary ceiling. To get a better feel for the stock's current energy, we can look at the RSI. Right now, ASTS's RSI has recovered from its lows to just under 50. This is neutral territory. It tells us that the intense selling pressure has eased, but a powerful new wave of buying momentum hasn't taken over yet. The stock is essentially catching its breath, with buying and selling forces in a temporary state of balance. So putting it all together, what should you be watching for? It really comes down to a key price zone, between roughly $49.50 and $51.70. This area is now the critical battleground. For the bullish case to continue, we would need to see the price decisively push above this zone, ideally with an increase in volume and with that RSI gauge climbing above 55. If that happens, it would signal the buyers are regaining control, and the path of least resistance would be a retest of those recent highs around $55. On the other hand, if the price tries to rally into that zone and fails, getting pushed back down, that would be a sign of weakness. If it then falls below the key support level around $46.40, the odds increase that we could see the price drift lower to fill the gap from the other day, which means returning to the price level from before the big jump, down near $45.90. The main takeaway here is that with a pre-revenue, deep tech company like ASTS, you have to look past the surface level noise. The initial earnings reaction was a head fake. The real story is in the operational execution, the launch schedule, the government validation, and the strategic assets they are putting in place. That is what will determine the value of this company in the long run, not a single quarter's expense line. That's my take on it. I hope you found this breakdown useful. If you did, and you want more deep dives where we cut through the noise and look at the actual data, please consider subscribing to the channel. I'll be back soon with another one. Thanks for watching. DataCat out. Stay sharp and stay safe out there.